Have you ever wondered what goes into a due diligence report? Maybe you've seen our due diligence and want to see exactly what's in the report, or maybe you're interested in a mini Q of E and want to see what goes into a report if you request that from a different type of firm. Well, today I'm going to walk you through exactly what goes into one of our reports, which are a little bit customizable. And before we do that, I'm going to talk about the why and the how. So thanks for being with me. I am Natalie Cook with Finance Fight Club. And I love helping business owners get their business ready to be sold or looking to buy, specifically from the finance lens. What are your financials saying? How clean are they? Can you tell the right story? Today, I want to walk you through a live example of the reports that our team specifically builds. Before we get there, because I'm going to do a little screen sharing, I just want to talk about what are those reports for? How are they used? Who benefits from them? And why might it benefit you specifically? So the who or the why, if you are looking to purchase a business, this is a report for you to have done thorough due diligence from the finance lens to see if there is any risk associated with it. Now, one thing I think our firm does a little bit differently is that we are primarily CFOs. We're not CPA. It's not a CPA firm. So we are actually looking for the strategic lens of if this business fits into what you want from a portfolio of businesses that you might own. That is how we specifically write our reports and build our reports and think through it when we're analyzing all of the data. Now, a mini Q of E or a big Q of E, if you're talking huge ones, they're going to look really at the financials. Are they accurate? And what are they telling you? You're going to get kind of the same data. It's the same information. We're just shifting our lens to does it fit with what you want? Now, a buyer primarily uses this report if they are receiving data, they're under LOI, and they're getting this information from the seller. But they're also really beneficial if you are thinking of selling your business. This is something you can do at any point. It's different than a business valuation because that's going to get pinpoint a valuation point in time. It is really what is the health of your business? What are you going to sell? What are all the risks associated with getting this business on the market or to a buyer, or just longevity of this business? And I'm going to show you and talk about what we look for when we're taking this data. So both buyer and seller can utilize it. We've had a client longtime client, we actually did a similar mini pared down version of this report for her, and it actually got her buyers through their due diligence and through their financing. So it's a very helpful tool. You can send it to your bankers. You can send it through to a firm doing due diligence if you're in the sell side. And even if you don't want to send it, it's going to highlight exactly what you need to work on in your business so that you have the time to work on those items. I'm going to pause there real quick, and then I'm going to talk about what we put in our reports. And I will put this up on the screen and share that with you. So when we take on a project like this, we actually request a significant amount of information. And if you're not familiar with due diligence, yes, you can Google what that is and you can self-serve. But this is the exact list that we look for. And then if we want to do further due diligence, we can ask for more information. I have found that in the businesses that we primarily serve for these reports, which is businesses under 20 million in revenue, the data isn't always there in the level that you expect it to be. And so, yes, it would be nice to get so much more data or cleaner data or whatever, but we're really dealing with what we have. The big things that we want to request are 3 to 5 year financial data. This is your profit and loss, balance sheet. I like it to see it by year and by month. So I typically request exactly a P&L and a balance sheet by year for the last 3 to 5 years. If we can get 5 years, phenomenal. I've rarely seen that happen. Usually we get 3. And then we usually get the most recent balance sheet. I also want to see year to date. So especially like I'm recording this video in July, we would not want to move forward without a year to date. We would expect that through May. Hopefully we can get June financials. It's early into July. We also want a general ledger for the last 24 months. And this is key, ask for Excel files. PDFs are fine. We can work with them, but Excel is so much better because we can manipulate the data within the Excel sheet. We're also going to request 3 years of tax returns. We're going to request bank statements. Now, bank statements you can't typically get them in a .csv file for prior to 18 months. So we ask for about 18 months. I have actually rarely gotten this information in the due diligence reports that we've had. We usually get 1 to 2 bank statements just to verify the last few months. And I think that's sufficient. We do write in our reports, hey, we weren't able to validate it. Again, our reports are mini Q of E and not CPA audited financials. And I think that's a big distinction. The other thing we look for is a SIM. If the buyer has it on the market, it's nice to see. It's nice to see how the broker or the M&A firm put it up to market. Lease agreements, vehicle information, debt schedules for all liabilities, accounts receivable and payable aging reports, any revenue detail that they're willing to share, especially if it's not clear on the P&L. A lot of times they won't break out certain lines of revenue on a P&L clearly. And so we want that kind of how do we tell this right story? Hopefully it is broken out on the P&L. And I think this is where it can be so valuable for a seller to do this report, because then we can say, hey, look, these are the things that aren't clear. This is how we would want to tell the story to a buyer. An employee list, name, comp plan, years of service, and type is a 1099 or W-2, and then a transition plan. Now, we get a variety of these details. Primarily, we're looking for those first 3. And then if we get the rest, then we're able to do a lot more. And now I want to kind of go into an actual report and share what that actually looks like and how we do that. So we take this data, depending on how much data we get, we turn it around in 2 to 3 weeks. And then we do a strategy call with the owner itself, with their owner themselves, and say, hey, this is what we see. Now, again, we're looking at not just do the financials match the tax returns? That's one piece of it. We're also looking at, do the margins make sense? What's the risk? Is there a single customer taking up a lot more revenue than the rest? Is there anything else that would risk out this business? Now, a lot of things that I don't think most buyers are aware of is that founders provide a lot of energy to this business. Owners provide a lot of energy that employees don't. And so whenever you have a transition, things shift and things change. And there's a lot of risk associated with just the physical transition of the business. It's not always very smooth. And so you need to keep in mind, employees might leave, contractors might leave, your vendors might leave. All of those things have to kind of be validated on what is the risk associated with those. So I'm going to take a second to share a report, and then I'm going to walk you through it. And we're just going to go see exactly what we show a customer. And this is an actual report that we did. I took out all of the customer data, changed the date, changed the names of everything in there. So you'll see that in a second. So this is our due diligence report. We've got a table of contents. I'm not going to set my time on that, but we do a CFO report. So this is our overview. This is what opportunities do we see? What are the key considerations that we're looking at prior to you taking ownership of this business? In this specific example, there was one customer that ate up 49% of the total revenue. And that was very risky, especially because I believe this business didn't have these very concrete contracts. They were just kind of on, I think they were PO style contracts. So it wasn't clear if a new owner came in, how secure that was. Now, a seller, it's kind of like when you go to sell your house and you're like, hey, don't look too closely at the roof. Like we think it's going to be fine. And I worry about that sometimes when there aren't these contracts keeping everybody in place. Now, people can break contracts too. So that doesn't really necessarily mean what you think it might mean. The other one that we looked at is working capital. So they had a lot of inventory, and about 40% of their working capital was tied up in this inventory dollar amount. And it increased this requirement of cash to be sitting in this business. And I thought that was both a risk and an opportunity. They're kind of two sides of the same coin, right? Like, one opportunity is the new owner takes ownership and they're able to reduce this inventory. So one of the things that we talked specifically with this potential buyer about was to understand from the current owner why there was so much inventory on hand and how he did this purchasing. Like, why were they holding lots of inventory because the vendors took a long time? Were they holding lots of inventory because they could? And what was the reason for it? And then what was the risk of that inventory going bad? For lack of a better term, it wasn't food related, so it wouldn't have necessarily gone bad. It wasn't really gonna age or get damaged because of any time frame. It was just interesting that they held on to so much inventory at one time. Next, we kind of go into a deeper list of risks and opportunities. I thought that this was really interesting because they had a lot of growth from 22 to 23 and 23 to 24, but that it slowed in 24 to 25. And so again, that's something where you just can't predict what's going to happen. Anytime there's a transition, you should predict that that transition is going to cause your growth to pause or go lower, because it's just going to shift everything. The other thing was owner dependence. So they did have a really good transition plan in place. It seemed like they were all on the same page in terms of what that current owner was going to do for that transition. That looked great. But again, it's always a risk. Employees and key talent risk. We didn't get a ton of detail into the employee turnover. So that was something we called out to say to the buyer, hey, just double check these things. And then it was very asset heavy. So there were lots of vehicles and tools and fixed assets that would transfer. I just always recommend that you do kind of an in-person inspection on that and don't just trust what's been told to you. And then opportunities. There was a huge opportunity for more marketing expense. They were pretty low marketing. Now, we don't get exactly what they're doing for marketing. So we're looking at a percent of revenue allocation towards marketing, and it was really low. And so that tells me like, oh, wow, they could probably, if they had some extra capital, maybe there's opportunities to invest in that additional marketing and increase revenue that way and decrease their reliance on this one customer. They also had really good bookkeeping in place. They were very organized. They used an outsourced firm that was on top of everything. And it was just extremely easy to go through due diligence and ask the right questions. So we really didn't come up with anything that we thought anyone was hiding. And there was some labor efficiency and facilities and rent optimization that I won't go into. So then in addition to the risk and opportunities, we do working capital and cash needs, revenue and margin trends, expense behavior. How are those expenses changing year over year? Leverage and liquidity, asset risk, and APAR risk. Then this is how we do our quality of earnings. So for the most part, what we're looking at is, do the financial statements match the tax return and match the bank statements? In this case, we were only able to get their ending bank statements for 2025-24. And so that one we didn't do as much digging into. We were able to verify that, yes, they matched. They were doing their books and their tax returns on slightly different accounting methods. We were able to ask that in a question with the finance team and validate that, okay, this is not a risk. This is because of tax considerations. So you'll see that some of those numbers shift a little bit, and we weren't concerned about that. Then we go into our own health assessment of the business itself. So we're looking at year over year growth, the change in COGS margin over time. Now you'll see that shifts up and down. Gross profit shifted a little bit. Expenses shifted quite a bit in as a year over year growth. So that was fascinating. And then the net income. And we look at that really to show, is this business viable in the long run? And it seemed like a very healthy business as a whole. And we look at margin change over time and the revenue change over time. And then this is another one that's a big piece of it, is we look at customer concentration. Now you'll see like one customer took up 49% of revenue. That's highly risky, and we don't recommend that. So that was something we really pressed on that buyer to validate. And to say, hey, what's the opportunity to get out of that? How can you add more customers to reduce that risk of that customer? Or how can you build that relationship very quickly so that 49% doesn't become a risk? Then we looked at expense overview and breakdown. People took up the primary cost. That's not unusual. Then we looked at the cost of goods sold as primarily parts, also not unusual. And then we did a lot of working capital calculations. Now, this isn't even the final working capital. We continue to work with this client as they were getting SBA funding to validate working capital, because we wrote working capital. He had his calculation, and then the bankers also had theirs. And so we worked collaboratively in that to say, what's the bare minimum of working capital that needs to come into the business at the time of transaction? And then we do a final thoughts and summary. What else do they want to validate? How else do they want to think about it? And then kind of in this particular instance, what were the first 90 days of things that they would want to do after taking over specific to the finance team? In this case, I recommended they hire a fractional CFO to implement kind of longer term financial planning, but that they keep the current bookkeeping relationship intact because they were doing a really good job and it just smoothed the transition. So that's our report. That's exactly what we share with a client. We do a 1-hour strategy call, and then we support through that due diligence period. As more questions come up, we get on the calls with the teams if needed to answer questions directly with the finance team of the seller or buyer. And really we're at that finance lens of are the finances solid? Are they saying what we think they're saying? Is there room for risk? And really it's so that the buyer can make a really good informed decision on what works for them and what is important to them as they look to purchase a business. And for a seller, we look at what are the things that a buyer is going to look for? What are they going to flag? And how can we mitigate any risks so that the transition is smooth? A lot of times we're seeing the impact to the seller being decreased in timing of that due diligence period so that it doesn't get slowed, because that is exhausting. So thanks for watching today. If you are curious about our due diligence reports, I will link the exact page below so that you can check it out. And thanks for being here.